You know, in the world of finance, everything really comes down to risk. But how do you actually measure it? How do you speak its language? Well, today, we're going to decode a set of incredibly powerful tools that do exactly that. So let's dive into the fascinating world of the option Greeks.
You've heard this phrase a million times, right? It's what we say when something is just way over our heads, too complicated, too confusing to even begin to understand.
I mean, we've all been there. Whether you're trying to assemble some furniture with terrible instructions or trying to make sense of a really dense scientific article, that feeling of being completely lost, yeah, it's universal.
But what if I told you that in one very specific, very fast-paced corner of the financial world, that saying isn't just a metaphor? No. In options trading, it really is all Greek. And that's exactly what we're going to break down today. So what exactly are the Greeks? Okay, they're not ancient philosophers, but you could say they're just as wise. They are a set of risk measures, each named after a Greek letter, that traders use to understand how an options price is going to react to all the different things happening in the market. Think of them like the DNA of an options risk. All right, let's meet the first member of our crew. This is Delta. And we're calling it the Price Whisperer for a very, very good reason. It is, without a doubt, the most famous and probably the most important of all the Greeks. So Delta's job is actually pretty simple, but it is absolutely crucial. It answers one key question. If the stock I'm watching moves by $1, how much is my options price going to move? It's a direct measurement of how sensitive your option is to price changes. And here's where it becomes real. Let's say you see a delta of 0.60. What does that mean? It means for every $1 jump in the stock's price, your options price is expected to go up by 60 cents. It's a super clear way of seeing just how stock-like your option is behaving at that moment. And delta tells you which team you're playing for. Call options, which are a bet on the price going up, have a positive delta. And put options, which bet on the price going down, have a negative delta. They are perfect mirror images of each other. So yeah, if delta could talk, this is exactly what it would say. It's that immediate frontline indicator of how your option is feeling about every single little wiggle in the market. But here's the thing. Delta's value isn't set in stone. It changes. So if delta tells you the speed of your options price change, you need something else to tell you about its acceleration. And for that, you meet gamma. Gamma literally measures how fast delta itself is changing. So stick with me here. If delta is your speed, gamma is the gas pedal. A high gamma means your delta is super sensitive and can change really, really fast. That means your whole risk picture can flip on a dime with just a small stock move. And that is why gamma is the drama queen of the Greeks. It's what introduces all the curves, that non-linear excitement. If you see a high gamma, you better buckle up because your options delta is about to get very, very emotional. Okay, so far we've talked about risks that you can see, price moves. But what about a risk that's invisible, totally constant, and pretty much always working against you if you're an option buyer? Let's talk about theta. This one is a huge deal. Theta is the measure of time decay. Every single day that passes, an option loses a little bit of its value, just because there's one less day for your big stock move to happen. Theta puts a number on that daily loss. For anyone buying options, theta is basically the villain of the story. Exactly. Theta is the sound of that clock on the wall, just relentlessly ticking away at your options value. It's this constant pressure that traders always have to be aware of. All right, let's switch gears. We're moving from the slow, steady burn of time to the explosive, chaotic energy of the market. It is time to introduce Vega, the volatility diva. Vega doesn't care about price or time. Its whole world is volatility, which is really just the market's best guess of how wild or how calm things are going to be. Vega tells you exactly how much your options price will change if that forecast for future choppiness goes up by just 1%. And that is Vega's mantra for sure. When big news breaks and the market starts going haywire, volatility spikes, and Vega makes options way more expensive. And when things get sleepy and quiet, volatility drops, and Vega causes those same option prices to deflate. It absolutely thrives on drama. So, we've covered the big players, right? The ones that get all the attention. But there's one more Greek that's often just sitting quietly in the corner, and that's Rho. Rho's job is to measure how an options price reacts to changes in interest rates.
Now, its effect is usually pretty subtle, especially for options that expire soon, but it can become a much bigger deal for long-term positions. It's a little reminder that even the cost of money itself plays a role here.
And that just perfectly captures Ro's whole vibe. You know, while Delta, Gamma, and Vega are all fighting for the spotlight, Ro's perfectly happy being a background player, just influencing things in its own quiet, subtle way. So, what is the point of all of this? Why learn about all these different personalities? Well, the real power comes when you use these Greeks as a team. A trader can use them to build a portfolio that's protected from small price moves. Or maybe they're watching Gamma to manage some wild, non-linear risk. It's about seeing the complete picture of your risk from every single angle. So let's do a quick roll call of our cast of characters. You've got Delta, the price whisperer; Gamma, the drama queen, always keeping Delta on its toes; Theta, the silent thief of time; and Vega, the volatility diva who just loves a bit of chaos. Together they give you a dynamic, living language to talk about and manage risk. See, once you understand the Greeks, you're not just guessing anymore. You are literally reading the language of risk. You're decoding how and why your positions will react to every single twist and turn the market throws at you. So the real question is, what are you going to do with that knowledge?